We are at PMS Bazaar Summit and I'm delighted to be joined by stock market veteran Devina Mehra ma'am. Thank you so much Devina ma'am first of all for taking the time out and joining us here on BT TV. My first question to you would be about Indian markets only. I mean Indian market continues to remain volatile. We have bulls and bears completely tug of war between bulls and bears that is happening at this point in time. But I want to understand from you now that what should be the strategy and how are you approaching markets at this point in time?
Hi. Now, as far as markets being volatile is concerned, I mean, that's always the case in a sense, right? So, I mean, I always say that in theory, everybody says that, yes, we understand that equity is a volatile asset class, that equity is a high risk asset class, that it will give you the returns, but with more volatility. But when you're actually living through the volatility, which may not even be very much, I mean, right now it's not as if the indexes have crashed, but when you're living through it, it suddenly seems that as if it's a strange new animal. And actually, the thing with equity is this, that not only do returns vary each year, they can even be negative, as you know, and also they can vary for a very long period of time. So if you invested 100 rupees in 1980, in 10 years it would have become 700 rupees. But if you invested in 2010, in 10 years it would have become only 230 rupees. So that also gives you a clue that returns were very subnormal in that 2010 to 20 decade, which is why it is not as if that you are at some historic highs from which the risk of a crash becomes high. So you are still below the trend line. I mean, if you talk of a long-term trend line of 15-16% return or even a little lower than that, you compounded not even 9% in that decade. So you're far below the trend line even after this, bull market after the COVID lows. So that's to put it in context. So I am still positive overall on Indian markets, also relative to the world. India is in our outperforming bucket. But you have to be very cautious on the small cap side of the market, which a lot of new investors do not understand what the risks of that are. So, right.
When you talked about mid cap and small cap, we have seen a stellar rally when it comes to mid cap, small caps. So how to really identify the stocks which are good for your portfolio and how to really avoid certain section of those stocks?
See, whenever there is too much euphoria about this segment, that it brings it towards the peak of that segment. So first of all, you must always limit your exposure to small caps. As a PMS house, we don't even look at micro caps. We don't look at stocks below 1,000 crore market cap, and even 1,000 to 5,000 crore market cap, we keep it limited at the maximum to maybe 20-22% of the portfolio, because otherwise, the kind of pain that sector can give you, that segment can give you. I mean, just to tell you, in 2008-9, the small cap index, the index itself came down 78%, so almost 80% fall. In 2018-19, again a 65%, almost two-third fall. So one other thing I want to leave for the viewers, that people don't understand that percentages are not symmetric. If something falls 80% and then goes up 5 times, you are at zero. So many people I now see talking about the track record for 2 years. If something falls 2/3, you triple, you are still at zero. So, but you can talk about tripling, that yes, I tripled in 2 years. But that makes no sense. And also I'm still talking the index. The small cap index itself churns a lot. So in 5 years, you have a completely new index. So the stocks that fell are not the stocks that make the high again. So be very careful in that segment, and especially for new investors, I would say, largely avoid, because you cannot make that judgment most of the time. And even as far as small cap mutual funds are concerned, there's too much money coming into them. So if you see, some mutual fund that may have looked at a universe of 100 small cap stocks now has to look at 200 simply to deploy the money. So which means criteria getting diluted. So a lot of places where there should be caution.
Absolutely. And ma'am, there was one session here on investing in VUCA world. So VUCA, I mean that markets are volatile, they're complicated, ambiguity is there, and there is uncertainty as well. So how to really invest in these kind of markets?
When are they not? That is the thing. So I mean, people just like these nice acronyms. I mean, in that post-COVID world, I think there was so much news flow on whether vaccine will come, not come, lockdown, open up, again lockdown. So that, always there is some reason to mention this, and I don't think currently the time is particularly strange times or anything like that. I don't see anything extraordinary about current times compared to the markets. This much of news flow uncertainty almost always remains.
But ma'am, because of geopolitical tensions and the escalated tensions in the Middle East, that's why I'm asking this.
So last year when that Russia-Ukraine war broke out, on the day the war broke out, so if you remember there were a lot of turmoil before and then when the war broke out, so we are very data driven. So we actually looked at data for 40, 50 years of every major geopolitical event, the two Gulf Wars, US bombing Libya, 9/11, Afghanistan, whatever. And the takeaway was this, and I said it on the day the war broke out when the markets fell 5% on that day, so not in hindsight. I said that the markets will forget this before you know it. Because that's been the pattern, not on the average, but in every single instance, that there is turmoil around the incident or around the time that anything like this starts. But it doesn't last, not for markets which are not directly connected. So I said, as far as, for example, Russia, Ukraine, I said to the extent it has an impact on commodity prices, because both these countries are major commodity players. To that extent, you have to see what happens to certain economies or certain company results. But on the whole, markets will forget it. So 6 months after that war, I remember there was some newspaper coverage. The markets have forgotten it. I said it on that day. So this also, the Middle East thing is fairly contained. It's a humanitarian tragedy. I feel really bad about all the babies and civilians getting killed in Palestine. But that apart, as far as markets are concerned, I mean, we all have this narrow view of only markets. So I don't think this is of great importance as far as markets are concerned on a long-term basis. On the other hand, see, the other thing is that wars don't have a long-term impact on markets, but wars last far longer than how long you think it would. Now it's a year and a half of Russia, Ukraine, and even when adversaries are very mismatched, that US versus Vietnam or US versus Afghanistan, even then nothing gets over in a fortnight. So that's the two aspects, but all of us have this myopic vision of only the markets. so.
But since you are with us, for the next 6 months, which sectors would you like to, recommend, or any themes that are on your radar at this point in time?
So, I mean, the sector we are still most overweight on actually hasn't changed in 2 years, which has been capital goods, industrial machinery. But that, I mean, every quarter we evaluate whether that has run its course, that, that theme. So, I mean, till now our systems have not signaled complete pullback from there, though we have cut weightages. Currently, we would also be overweight auto components, pharmaceuticals, selectively a couple of construction companies also. But it's all, a lot of it is bottom up rather than pure sectoral.
And lastly, ma'am, since you're with us, there is this debate that is going on 70 hours of work culture. So for young Indians, so some are saying that it's a good idea, some are completely against. What are your thoughts?
See, one thing is that when you are young, you do have to put in a lot of time, especially, I mean, I'm talking more from my business, which is a learning business. I always say that at the beginning, you have to put in those, not necessarily in the office, but you have to do that much of learning. You have to put in those 10,000 hours of work to be really proficient in it. But overall, in general, working longer hours means productivity goes down. I mean, this is well understood all over the world. So it's silly to say that you work 70 hours a day and that will be just what you're doing into X per week. Yes. So I mean that's not going to work out. Also, it leaves out. I mean, it assumes that people have no other responsibilities outside work. I mean, currently, which I want it to change, but currently a lot of women, for example, have a lot of other responsibilities. So, they are not going to be able to work. And I mean, as an employer, I can tell you that hours of work don't equal the output. So, I mean, we were talking about women, for example. I've had women in research who at times were more rigid about not staying very late because of various reasons, but they were more productive. And whereas a lot of the men would waste time, take smoking breaks, talk to someone on the phone, and just say that, okay, I worked late. So I am focused as an employer. I can tell you, I am focused on output. I am not focused on number of hours, and it is a well-known fact that productivity is not high when you work too long.
Yes, absolutely. On that note, thank you so much, ma'am. Thank you.
If you like the video, do like, comment, share and subscribe.